Finally, this week we will see option pricing because last week it was I was, I was not satisfied with that chapter because it was half finished. That we were talking about. So we were talking about probabilities of prices are going under some thresholds or going above some thresholds, but once it started to become interesting, then it ended suddenly. So that's why fifth chapter. It's much better because it starts with option pricing and black source, and after that it starts to stress the whole concept by checking the different kind of risk which can be involved by the changes of prices, changes of volatility, changes of time, and changes of other things. So it will be much more interesting. So first of all, we should start with Annex A by defining the valuation of European options, which can be highly familiar from international financial management. So, okay, we know this one, that one as well. This is what we talked about last time. And in this case, we can see that already we have this concept that what is the present value? Because if last week I was sometimes not consistent, I think that so if we can see the minus sign here, it's always a present value. If it's not there, it's a future value. So this is the sole indicator. So if we have to have some kind of targeted price and also something in the future or present, doesn't matter, but if there is a difference, then it will come back again and again, because practically this is what is coming, or what we can see not just in the case of futures but also in the case of options as well. So yeah, practically the entire concept will be built on this really small line, because after that we can find it. Right now it's never or nowhere, because the other part of the concept is this one. So the idea of taking thresholds and what is the probability of being above the or under the threshold, it doesn't matter, because still there is the division here. So taking that where they are going to, and after that we cannot just using this for calibration of probability, but practically we can use it for other purposes. So we can see that what will matter for us, the probability distribution, as we were able to see that what is the shape here, and yes, we can maybe replace it with other distributions. Just the problem is that in this case the parameters would change as well, so it's not that easy to get rid of them. But if we are focusing on new things, then we can see that practically the Black-Scholes Merton formulas for European call option pricing is practically utterly the same. So what we had here, so already D2 and D1, which is quite similar. Just here is a minus because it's going under the threshold. Now it's going above the threshold of the value of money, but otherwise they are completely the same. Just it says that, okay, let's combine this one, the D2, with this concept here. So right to buy or right to sell an asset with a price of K, then practically it says that, okay, we should take or divide this equation. So now we should take this as practically in this case it will be accounted not as FO but as O, so spot price right now. And then let's put it in a probabilistic level. So let's say that what is the probability of this one, that we are under this level. Then we know this from the last week, so we have to correct it this one. Just in this case we're above this, so it's a plus. And also if we are looking for the targeted rate, so where we have the right to buy the asset, then obviously it will be also probabilistic. But since it's in the future, because we have the right to buy this stuff in the future, then that's why we have to deal with the present value of this key value, so we should not forget about that one. Because obviously in the case of the spot price we don't have to do present value calculation, so this one is here, there is nothing like this. So that's why it's funny that we can build up from all these components the entire Black-Scholes formula. In this case, practically not the Black-Scholes formula. What is the tricky formula here? That someone had to be reached for this point, to this point. Until you were able, or someone was able to reach to this point, then to understand that, okay, what is the probability of being above or under a threshold, then after that it's quite obvious. Or at least seems to be obvious. Okay, so let's build our Black-Scholes formula. Because now we can do it with our hands. I mentioned it's obvious, so what can possibly go wrong? Yes. Nothing. So Black-Scholes Merton formulas. Okay, first of all clear, if I have to repair something. And also we can remember that we had this notation, so yes. So last week I created two MATLAB file, and the first one was containing all these building components, and the second one was actually the seminar work. So let's see. Right to buy. So we are building. I always prefer, I don't know why, but I always prefer call contract. So let's start with my favorite, to buy. And of course, if I don't want to make a huge mess, I mean bigger than the usual, then it's necessary to define everything. Well, just we know that in this case it's not S, it will be F, it will be S0, because later equations will be using this one. So S0 must be defined, K must be defined, R must be defined, and the time T must be defined. So let's say 180, 0.1, and 1. In this case we can test it, that how does it work. Does it able to run? We can see that, okay, the equation is working. Because if we are in a state of not working, then we should be able to see that. Okay, maybe I will put it here. It's more refined to see that. And also, what do we need here for cooking? So I added this ingredient. Then we need the higher level of D2, and also we have to generate a D1 to the game. So because last week it was not presented. So So being under a threshold. It's D2. Let's check that is this correct. It was correct, just to be precise. Before I have to run a lot of debugging to looking for a bug, but it seems to be okay. It's plus, plus. It's still a plus, it's still a minus. So I don't have to be afraid that. And also, the D1 is just popping up. Maybe there was a description in the book, but right now it's just coming from the skies that there is also this one. Well, the only difference between the D1 and the D2 that here is this positive sign and the rest of them is completely the same, so we just have to change that one, and now it's called D1. Okay, but we need to calibrate this. So now it's not V anymore, now it's under a threshold of K. Because now we have the target price, so we have to create some consistency inside the equation. So you are this one, we have S, but still we need mu, so let's define additional variables, mu, sigma, T is already defined, sigma T, okay, so we don't need any more. 0.05, and I don't want to give the same numbers because in this case, let's say 0.2. Can you run? Yes, it can. Good. Then now finally we can combine them together. So option. And after that we will build, obviously we will check it back with sophisticated functions, and we will see that how can we do this with the official ways of MATLAB, but we can do it because we are wise enough. So option phi equals, so as we can remember that there is the part of the equation, and in this case obviously we don't have to care about the S0 anymore because we don't want to look for its present value, so just the targeted thing must be, and this is also minus. This U should be also minus. Let's put it back. So now it's nicely losing it, so now it's discounted. And then we should put everything to probabilistic level, so there comes the D1, and here comes the D2. But we know that this is not enough because we have to add also the normal distribution. So right now it will provide us, okay, it's running and it's giving us numbers, just we don't have to, or it would be really strange to do that. So before any kind of application we need the inverse normal distribution. Norm inv. Practically, if we are not calibrating mu and sigma, because it could be misleading, because right now mu and sigma is not the same mu and sigma what we are using. So let's just using the old school normin. So in this case, we can say that normin v1 this must be inverted. No, it's not inverted. Oh, yeah, sorry. Why I was remembering inverted? It was also not inverted. That's why it's probabilistic. Okay. Norm list. No. Last week we used it, so let's go back to, yeah, CDF normal. Okay. Do we need to calibrate that one or not? One. Can you run without any? I can see it's running, just so 0, 1. I need to calibrate it. Okay. So there are no default values. Yeah, I was even writing to myself that this is norm dysfunction, not the inversion. Yeah, maybe sometimes I should read my own notes. What is this? This is not negative. Okay. There's one multiplication mark. The other is also valid. Checking again that no, I cannot. They must be. So now let's see that does it have a value? It has. So this option fee is happily working. Or let's say not option fee, but option call. And let's create also the put option here because option put. Okay. So it will be the opposite, just in this case we can see yeah, that's why I don't like when the book suggested that, oh, now it starts with the decay, but practically what happens only that the signs are changing. So what was positive, now it's negative, and so it's I changed that one because that was not elegant. Now we can see that the location of the variables remains the same, just we can see that. And also we should not forget about this one is negative also inside. So the put changes outside, and also the D1 and the D2 will be also negatives. And we don't need the closure because we would like to see the end results. Yay! And now we created our homemade, handcrafted. Oh, my shoe is ready. Okay. Or at least someone is calling me from Szeged, but I think that the store. Yeah, but still we need a further calibration because one thing is missing from the original one. So in the original concept it was mu, but practically this is the risk-free rate here because we have an expected growth rate, and the expected growth rate is the risk-free rate in Black-Scholes world. So we have to say that it's not mu anymore, it's R. Sigma remains sigma, so we still have the risk, obviously, but so we have to eliminate the mu as a variable. It's still working, just now with different numbers because of the mu was eliminated. And after that we can develop things further. So practically we can still add an add-on from last week, and we can remember that there was a situation when we had this yield at rate Q. So when the asset provides us some extra dividend or whatever. So this whatever must be built in. So that's why provides a yield at rate Q. How can we process this? Practically, we just extend the present value calculation. So here. And yeah, right now it's future value, but we can convert it back. So we can say that now it's present value. So what matters that if we have any kind of growth thingy or benefit from this one, then what we have to do, only we have to recalibrate the present value component of the entire equation, and that's all. So we don't need any kind of fancy changes. Foreign interest rate. And this is the funny part. So it doesn't matter that we are talking about a dividend percentage or a foreign interest rate if we are talking about exchange options, because we are behaving completely in the same way, just with some extras. So sorry, and yeah, so with some extra. So in the past, in the original equation, we did not have to care about what is happening with the spot value because it was not growing at all. It was not paying interest if it's a currency, or it's not paying dividend when it's a share. But now, since it's growing, now we have to deal about this one. So that's why it will have also present value calculation that we have to acknowledge that this thing is behaving like this way, and also I'm making this more elegant. Why I was doing this? I know that in last semester it was also, I hate it. this kind of representation, but somehow I stuck with that one. Yeah, so let's repurpose. So now we have the growth rate, but now this is not R, this is Q. Q, Q. And after that everything remains the same, so we can see that we don't have to care about the targeted thingies in the future, it's there. But we have to think about the D1 and the D2 because they are absolutely affected by this trade-off between the growth of the asset in average and also the dividends and additional features. So that's why these must be corrected. Okay, so we can see that it's quite simple because just we have to say that okay, minus q in all the cases. So because the logic from here will be the same, that we don't have to care that much. So q, and also in D1 minus q. So the equation looks ugly, but practically if we are taking the basic components, then it's relatively easy to build up. Now we know. Sorry. Q will 0.02, okay? Now it's this one. What is your problem, my dear? Ah, sorry. Yeah, minus, yeah. Yes. If so, is there any kind of difference between the two rotation? Obviously, the option call fee should be smaller after we did all this present value calculation here and also the decrease in the D1 and D2 values because of the difference. So let's check this hypothesis. Yeah, it was 27.9 and now it's just 26. So we lost some things because of the division and also of the difference and also 0.38. This one is growing. Why? Because obviously it's upside down, so this one is negative, so it's really happy, and this one is just there. Yeah. So it's growing, but okay, this is a put option, so it's supposed to go in the opposite direction than the core. Yeah. So now we know everything about option pricing. Let's see that how can we deal with this at the level of MATLAB. Because you could say that, oh come on, if we can do this, why to pay any kind of money? So literally you can build up the same thing in Excel. It's painstaking and it's really hard to find any kind of bugs because Excel doesn't show us or support us if we are using it traditionally. But let's see, is there any kind of added value if we are using? Okay, so, and we have this not this. If I'm not able to find it immediately, then I will look for it. Just I know that in the past it was in front of my eyes. Yeah, we would like to reach to this point, but okay, if I'm not able to find it, then I will open the well-performing script. Because international financial management we did not use this. So, but on investments we are using. So I spent a lot of work to create a Hungarian lecture note. That's why we can use it backwards. So let's transform back everything again. Because as you can see, so we were able to build up everything within 4 lines of code, but if we are using the professional MATLAB functions, then we can do it with some more features. So first of all, I'm checking that co-output, American, and so on, flat rate. Okay, I save it, upload it to CodeSpace to you, and then you can download it, and after that we can continue. So. Yeah. I'm in the wrong direction. Folders. Did I save it? I saved it. I'm checking that is this thing running or not. Did I miss something to copy here or not? Because before I start to debugging anything. Nice. Okay. I can copy it now. Okay, so now you can download it. And after that, we start to check that is this thing more complicated, less complicated, and how can we develop it any further. Okay, it seems that you are ready. Okay, so in case of the MATLAB coding, there is somewhere a really good tutorial built in the MATLAB, but I was not able to find it for today. But it doesn't matter. So practically, first of all, there is this dividend, but this is a dividend ratio. So it's not a number, it's a percentage. Because if you are writing numbers there, it would give us really strange numbers. Okay, we have also the volatility, so the sigma is the same. We have a spot price of something and the star price. So the behavior is same, just here was small letters, not big ones. right now let's not define any kind of dividend. The added value here that we can define exact dates. So now we can see that, oh, which year we are. So yeah, and 3 and 8. So it has an added value. And also now we can have this rate. So this is the R what we defined. So well, we can keep it this way. Also the basis can be defined that this interest rate is annualized, so this has nothing to add later on. So yeah, and also we can calibrate the maturity. So we don't have just this 1 year option or 2 year option, but practically we can calibrate at the level of days. Right now we are not sophisticated, so the saturation maturity is just 1 year backwards. And that's why, so the exercise is supposed to be in the future, so it's 2014. Doesn't matter, because it automatically it will gives us a 1 year option. Then we can have call option or put option. So we have this switch, and after that I had to build in also a secondary function here, because it can also calculate American option. And for some reasons the book will define later the American option, so not today. But the difference is that American options can be executed before the expiration date of the option. And in this case, the Rolle-Gaskell-Whaley function will be used, which is quite a disgusting thing. So until we can easily build up the equation of Black-Scholes or European options at or in MATLAB by hand by just following the equation, this is the American option, just for call. So because the main problem is that this thing will grow until the unknown future when we are converting it backwards. So here we have this S apostrophe or S star, which will be the price when we would like to use this option, when to execute this option. So suddenly the target price and this future unknown spot price will be completely two different variables. So you have to deal with this splitting in the unknown future. So that's why it must be rolled through all the parts of the equation, and this will be really disgusting. So it was a happy time when I was able to type in everything by hand, but also you can see that time until expiration must be also added to the equation, so that's why this small t is here. So yeah, it's ugly. But that's why we have MATLAB, because the Rolle-Gaskell-Whaley option pricing, if we are just setting it to American, then automatically this variable will be set to this function. The question is that this Rolle-Gaskell, so the other American option valuation, would require this small t. And this small t is completely missing from the calibration. So it says satural maturity, but today is day thingy, it's missing. Maybe I can dig it up, just right now it's not calibrated, so we should be careful about that one. Okay, so and after that, the usual fin instrument, fin model, rate curve, and pricing. Oh, sorry, fin pricer and pricer functions are used, like in the case of the when we were computing bond values. Yes, here. So the structure is completely the same in the equations. Just in this case, the meaning and the input switches are used a bit differently, but not that differently. So we have a fin instrument object to create, so we can say vanilla, and after that we can have exercise date, strike price, option type, exercise style. In this case, this is where it only decides that this is a European or American option. So there is only such difference in the definition. So here is we are not able to define the small t. So there is no opportunity for that one. Then there is a fin model selection, which creates also just an object. So there is no calculation behind, it's just organizing the input variables in the desired shape. So black source, okay, volatility, sigma. So that's why I had no idea why it's not combined into one. So why do we need two functions for defining inputs? Because, okay, here we are defining the target rate, maybe we could add sigma as well. So here I can see the added value. Maybe it has a deeper reason why they were separating these two things, and later on we will see it, but right now. Okay, and also, if we remember on the bond pricing, we had this nice rate curve object with so many different, so we had the entire yield curve. And after that, this is when it was used for present value calculation. Right now, this is utterly useless. So we can see this is not a yield curve. Right now, this is just defining that we have an interest rate. And all the other things, and settle and maturity time, so practically the big T, time until expiry is also defined here. But that's all. So exercise dates. Maybe small t can be calibrated for the American option here if we are tweaking it enough, but okay. Because otherwise settle date, maturity date is there, so if we are playing with exercise date, then we can have the small t. Okay, let's remember this fact. Then there is the fin pricer. So it's again setting the discount curve, which is just 1R. So literally. So if I'm checking my RC, that it has, yeah, this right here. So it's quite stupid. Just I think it was way easier to write the code in this way because it will be used multiple for. I think all the financial toolbox uses the same logic. So okay, so analytic discount curve IRC model black source model, which is funny because black source model will be referred also during the American option pricing, which is this one. But it's working like this way, so okay. SO dividend. Yes. When the dividend will be paid, we have to also calibrate that one here. So maybe we have the chance to define also the T in specialized ways and and pricing method. And pricing method was defined here. So this is where it gives that we need a Rogers-Rayleigh option pricing, but since it's a derivative of the black source model, still the main model which will be used is the black source model. Just after that, maybe decides that okay, let's go with the other one. But so if you are selecting this outpricer, so again it doesn't contain so many things. So it's just this thing is just organizing stuff, and after that the magic happens here in the last line again. So the actual pricing, and we have nice outputs, and we can see that it's 151. So after that, let's see that is this thing consistent with our previous calculations. So let's calibrate our model with the MATLAB one. So sigma 0.2 S0 100. Strike price was 80. Dividend right now is 0. We have 1 year option. Rate it's so nice that it looks like it was created by people of marketing, because it's so long, so you can see that this is doing a heavy job, and this is not just 2 lines of coding. So at least until this is at the level of black source, because after that it's an American option, then okay, it could be much more heavy dutier feature, but we can see that the numbers are the same. So it's 28